Downtrends rarely turn on a dime. More often they end with a double bottom, price falls to a low, bounces, and then comes back down to test that same low a second time and fails to break it. That failure is the market telling you sellers have run out of ammunition at that price. It's one of the most reliable reversal patterns in swing trading, but only if you trade it the right way, because the same shape that becomes a powerful reversal can also keep falling straight through. Here's the full anatomy, the exact trigger, and the mistake that turns this great pattern into a loss. The pattern has three parts. First, two lows at roughly the same price. They don't have to be identical to the penny, just close enough that the chart shows support holding twice. That repeated hold is the evidence sellers are exhausted. Second, between those lows, a bounce that forms an interim high. And the horizontal line across that high is the neckline, the single most important level in the whole pattern. Third, the confirmation. Here's what most people get wrong. The double bottom is not confirmed when the second low holds. It's only confirmed when price breaks and closes above the neckline. Until that break, all you have is support being tested, which could just as easily fail. The neckline break is the pattern. Here's the mistake that turns a great pattern into a loss: buying the second low, trying to call the exact bottom. That's just guessing. The low can break and keep falling. The pattern is only real once the neckline breaks. Patience, there is the difference between trading a confirmed reversal and catching a knife. The trade is clean and fully defined. You enter on the close above the neckline. That's the confirmation that buyers have taken control. Your stop goes below the double lows, because if price falls back under the level that twice held, the reversal thesis is simply wrong and you want out small. Your target comes from the measured move. Take the height from the lows up to the neckline and project that same distance above the breakout. So a setup that looks like it's just bouncing off support actually gives you a precise entry, a logical stop, and a calculated target, all three. A common refinement: if you want a lower risk entry, wait for price to break the neckline and then pull back to retest it as new support before going long. On real price, look for that twice tested support and the neckline above it. When support holds a second time and price then reclaims the neckline on strength, the odds shift from down to up. The real chart rarely looks as clean as the textbook, but the logic, two failed attempts to break lower, is what you're really trading. Reversals are where traders get hurt, so demand confirmation. The double bottom gives you a structure flip and a precise trigger in the neckline. Add momentum turning up, a higher low on RSI, expanding volume on the break, and you've stacked the signals. Never trade a reversal on hope alone. So, two tests of support, a neckline above, and you enter only on the break. Stop below the lows, target the measured move. Don't guess the bottom, trade the confirmation. Subscribe for the full method and trade your own plan. This is education, not financial advice.